We're here to talk about an innocuous-sounding three-letter acronym, which actually is a pretty coercive philosophy, and that's ESG, environmental, social, and governance investing. ESG in some ways actually represents a breakdown in the wall between the nonprofit world and the for-profit world. And it's created a new paradigm where political and ideological statements take precedence over returns to investors and running a successful enterprise. And we're talking about ESG here at the annual meeting because all of you in this room and you two on this stage represent an incredibly important block of investors. Indeed, at the end of 2021, the total assets of US foundations hit $1.3 trillion. That's a lot of power. As you invest your foundation assets and your personal assets, it's important to keep in mind how that money and the proxy votes that are tied to it are being stewarded. I'm lucky to be joined on stage by two gentlemen who are going to help us think this through. They're close friends of the Roundtable. Sean Filer is at the end there. Sean is the president and CIO of Equinox Partners, a global value fund focused on emerging markets and gold mining. Sean speaks and writes on a variety of topics, including monetary policy and ESG. I first got to know Sean through the American Enterprise Institute. He is the chairman of the American Principles Project, Communio, and the Knights of Columbus Charitable Fund. Thanks for being here, Sean.
Thanks, Little.
Our second guest is Vivek Ramaswamy. Vivek is a successful entrepreneur in the healthcare, technology, and finance sectors. He's also a member of the Roundtable's board, and we're really glad to have him here with us. Now, my dad has this little habit that Vivek doesn't even know about, which is he texts me every single time Vivek is on TV. And 2 years ago, that was maybe 15 times a week. Now it's 350 texts a week. Vivek is out there in the media, and he's speaking around the country, sharing our values with the general public, and it's fantastic. But when he's not doing that, he's found the time to start a new asset management company called Strive Asset Management. And the goal of that firm is to lead companies to focus on excellence over politics. I think we can all agree that's a really important thing to do right now. Vivek's the best-selling author of Woke Inc., and most recently, Nation of Victims. Vivek, thanks for being with us.
Thank you.
Instead of going into the history of ESG, which could sort of be a college-length course, I want to start with each of you and talk about what was the point at which you began to think that this philosophy was actually a threat to our value system, that ESG and the philosophy it represents could be dangerous. Vivek, you want to start?
Sure. Yeah, so before starting Strive, my last career was as CEO of a biotech company, and I'm going to discuss ESG and a close cousin of ESG called stakeholder capitalism, which is the broader umbrella under which ESG falls together. But I was asked to sign an industry statement that I actually hadn't paid much attention to. It related to a particular Trump order on immigration. I didn't have a view on the content of it, but I didn't sign it. I was a biotech CEO. The rest of the biotech CEOs had signed it. I took a lot of backlash for that. And it was interesting to me. It was fascinating what it was about the biotech industry that demanded every CEO to either be a signatory of that one political statement of condemnation or whether it was something to be castigated over. So that was the beginning of a journey for me. I realized that for me, the biggest concern that I had with this new model, stakeholder capitalism, ESG, which said that companies should focus not just on making products and services for their customers for profit, but that they should also advance other social values. What was really wrong with it? And I think there's two very different schools of thought here. I mean, at one end of the spectrum, you have the Milton Friedman view, which says that companies should focus on making widgets more effectively, and that grows the size of the economic pie for everyone and lifts everyone up. I agreed with all of that. But my main concern that I sort of discovered through reflecting on this was actually the inverse of Milton Friedman's problem with it, which is that I also think it sent a signal to everyday citizens that their voices did not matter in answering the political questions that we ought to settle in a democratic society through free speech and open debate. Whether or how to address systemic racism or climate change or whatever. These questions are important enough that everyone's voice and vote counts equally. And just because I was a biotech CEO or a fund manager or whatever, didn't give me more authority on those questions. It might give you more authority in deciding which products ought to rise to the top, but not which ideas ought to rise to the top. And that's what led to the journey of writing the books and eventually starting a new asset manager focused on addressing the problem.
It's a good journey. Sean, what about you?
So, as a money manager, we've seen CRS, corporate social responsibility, which is kind of the precursor to ESG, was out there, relatively benign, and companies just weren't hyper-political. They weren't really taking these aggressive positions internally or externally. And then I think that, for me, I really saw it flip in 2011 in New York with the gay marriage fight. So you had companies basically come out, this is a year before Obama was in favor of gay marriage, write an open letter pushing for gay marriage in New York on the idea that to be competitive, the state of New York had to have gay marriage. And then you saw echoes of that in the RFRA fights in Arizona and again in Indiana in 15. And then the next instance where you really saw business to come together around a really controversial issue and act with near unanimity was in 2016 in North Carolina with the HB2 fight over the bathroom bill. So basically, I feel like in New York, I was there at we saw the inception of it. I know Paul Singer's here in the audience. He certainly saw the inception of this. But that's really when we took corporations that were averse to these kind of political fights, contentious political fights in the culture wars, and migrated to where we are today. I think kind of where we are today with ESG and BlackRock in particular leading the movement where you've added on not just DEI, but global warming. Some of that's Larry Fink trying to be Secretary of the Treasury in the Biden administration, which obviously didn't work out. But the groundwork was, I think, really laid going back to the marriage fight, going back to 2011 in New York.
That's a great segue to the next question, which is, how does this all tie into the broader culture of virtue signaling in the corporate world that can lead to such hypocrisy? So it's think of a pension fund that won't invest in anything related to Israel, but will invest in a company that has a factory in China that has Uyghurs in prison camps. There's some real hypocrisy. How does this all tie together with that, Vivek?
Yeah, so I think there's deep-seated hypocrisy. The example you just mentioned, the BDS, the boycott, divest, strike movement or sanction movement, is exclusively focused on Israel. And there's a close cousin of the ESG movement. And as Sean was talking, by the way, it's a funny little side observation to make. It's funny how these come in three-letter acronyms, right?
Always.
CSR, corporate social responsibility, DEI, SRI, sustainable responsible investing, ESG, BDS, CCP. And I think
out a trend.
it's all actually part of the same game. Now, I think the China dimension of this is underappreciated and I think worth discussing. So I know you all heard from Mike Pompeo yesterday. He and I actually co-wrote an op-ed in the Wall Street Journal a week or two ago on this issue, on the economic and even geopolitical impact it has in the U.S. So what China has recognized is that this ESG game is actually an asset. It's actually a way to weaken the West while simultaneously relatively strengthening China. Why? Because the very firms that will tell Exxon and Chevron, who I wrote a letter to the board of about a month or two ago, they will tell them to cut oil production effectively through emissions caps, through Scope 3 emissions reduction targets. Yet while they still own firms like PetroChina on the other side of the world, they don't apply those constraints. They don't say a peep. And the reason why is that the CCP, if you apply an ESG constraint to a Chinese company, they will tell you to close the door on your way out. But if you actually apply those same constraints to the United States, they effectively roll out the red carpet. And so in a certain way, it's not just hypocrisy. If it was just hypocrisy, I wouldn't merit a great degree of commentary because there's so many ways in which corporations and organizations are hypocritical. But this is actually a product. And I know it sounds conspiratorial. It's a conspiracy reality because it's hiding in plain sight. If you listen to Xi Jinping, he's basically articulated as much as his strategy. When he is pressed on the Uyghur human rights crisis that you just mentioned by the UN, the first thing he often says is that Black Lives Matter shows that the United States is no better, which would be a laughable idea if it weren't for the fact that our own corporations, through the S prong of ESG, lend implicit credibility to that claim, relentlessly criticizing slavery 250 years ago in the United States if you're Nike, but without actually saying a peep about actual slavery in the present day that you use to produce your sneakers that you sell to black kids in the inner city here for $250. So it's not just the hypocrisy, it is part of the intentional design of the CCP to attack the greatest geopolitical asset of the United States of all. And that is not our nuclear arsenal. It is our moral standing on the global stage. And so anyway, when the people who are always known to critique injustice are always critiquing the US without saying a peep about China, it actually has the effect of creating that false moral equivalence. Thank you.
Well said. Well said. Sean, talk a little bit about, on that virtue signaling side of things, you're investing across the globe. What's driving the demand? Why are corporations behaving this way? Because there is some demand component to it. They're obviously looking to maximize returns in some way. What's driving some of that, and what's creating that culture of virtue signaling?
Yeah, I think so. There is a fair amount of hypocrisy, as Vivek makes, I think, the point very well. And there's a lot of inconsistencies within these corporations in terms of how they're behaving and what they're prioritizing. But I think center-right or conservatives, to the extent that we're looking at the ESG movement and we think it is somehow artificial or a facade, and that at the end of the day, there's really an underlying intention is to make money and to align the companies with the incentives they have in the marketplace, and that at the end of the day is driving the ESG movement. I think that's mistaken. I think if you spend time with the executives, if you spend time with the board members, you'll see, like so many elite institutions in the West, in the United States in particular, these elites are true believers in this agenda. And they're willing to pursue this ESG agenda, certainly in the cases where it is in their financial best interest and where it's going to get them social standing, re-election, approbation, et cetera. But they're also willing to pursue it even when it's not in the financial interest or any kind of normal worldly interest of their business, because they are very much committed ideologically to these principles. And to the extent we don't believe they are, or we believe we can persuade them otherwise, I think we, as center-right or conservatives, are basically mirror imaging how we think about it, and that's just not accurate.
Yeah, I think it's about 60-40. I mean, I think that what makes it such a difficult issue is that sometimes you've got people who are doing it purely for cynical reasons that have no beliefs, are doing it because CalPERS and the state of New York told them to do it because that was a condition for managing their money. Okay, they'll say, oh, that's a deal, I'll make that deal, and I'll be a good-looking flag that waves in whatever direction the wind is blowing that allows me to accumulate greater assets or greater power. And then I think you also have, actually, I used to think that was the bad part, the cynical, hypocritical part. I actually think far more dangerous is the use of capital as an economic weapon to implement your political agenda without the backstop of political accountability. I hope he doesn't mind me telling the story, but I was at a dinner with Jamie Dimon that they hosted the so-called Founders Forum back when I was at a biotech company running it, and he was mouthing off about one political topic after another, and someone in the room asked him, Jamie, would you ever run for president? And he, without missing a beat, says, well, of course I'd want to be president. I just wouldn't want to go through the process of running for president. And everyone in the room laughs not because it was so obviously false, but because it was quite obviously true. And he was saying it, and that was in a more joking context, but I think that when you get to a lot of the Larry Finks of the world, I think part of the issue is that it's a great way to exercise quasi-political power. When the marginal utility of an added dollar has gone down, this is a great way to just take the political debates out of the political process altogether without the backstop of political accountability. And I think that's even more dangerous to the health of both capitalism and democracy than just the folks who are doing it cynically to make another buck, though I think both versions of it raise unique problems of their own.
Can I add one thing to this? Is
Sure.
Really, I think, interesting is that what I find really interesting about the movement is they're not doing it in isolation, right? When you're talking about the climate stuff or the carbon stuff, they're doing it in coordination with Climate Action 100. So they're forming these groups, which goes back to New York in 2011, certainly goes back to North Carolina in 2016. So they're operating within these in a coordinated fashion, right, where their message is, interestingly, it's not a hard ideological message. The message is about economic progress, right? So the way they defeated HB2 in North Carolina was saying it's bad for our state, it's bad for the economy in North Carolina, which was the same argument in New York in 2011, which is the same argument they're making today. But I think underlying that are some really strident, it's certainly Larry Fink and Howard Schultz and Jamie Dimon, or some, you have some very political CEOs. But I think you have a number of other CEOs that are also political, just not positioned publicly in the same way. Yeah,
I mean, I think the horizontal agreement with the Climate Action 100+ network is interesting. Since you brought it up, I think that's a great way. If you haven't looked up the Climate Action 100+ network, it's worth looking up. It is a global association, dues-paying network, representing $68 trillion under management of asset managers, majority market share in the asset management industry, that pledges to advance certain goals through their voting and advocacy power as shareholders. Now, normally, if you get market participants with majority market share getting together in a dues-paying network agreeing to cut production and consumer prices go up, say for gas at the pump. We have a word for that in this country. We would call that an antitrust violation or price fixing. If you had oil and gas CEOs together in a room, get together and say, we're going to coordinate to cut oil and gas production to save the planet, and then gas prices go up at the pump as a result, that would be an obvious case. Yet today, the largest shareholders of those same companies, Chevron, Exxon, on down, are effectively demanding that they do the same thing in coordination with one another, and somehow we celebrate that with a three-letter acronym like ESG instead. Yep. It is a bit of a mystery. Now, I mean, you asked the question about the demand side, and
right.
I don't know that we fully addressed that.
I think that's perfect. You got into an interesting thing, which is this collusion thing. And Sean, actually, one of the reasons you're on this panel is because you wrote a terrific journal op-ed earlier this summer on the potential antitrust case against it. Yeah. Do you want to talk a little bit more about that too? The proxy voter.
Yeah, so I mean, basically, I think we're in a fight. And if you don't realize you're in a fight, you're going to lose. The other side is pretty hardened, I think, in their positions. You're not going to get into a boardroom and persuade a board that has undertaken these actions, joined these groups, take these activist stances to simply reverse course because you're persuasive. And so we need every tool that's available to us to figure out how to disrupt their network, disrupt their way of behaving, which is kind of captured in the ESG ideology. And a part of that is going to be group formation. So fire engine number one is a great example of shareholders organizing to vote in the same way. These are blue state pension funds and big passive managers, BlackRock, Vanguard, State Street, basically coordinating to vote a certain way on a proxy to get directors elected. And they got 3 directors at Exxon. But when you do that, if you're in my business and you form a group with other investors to vote a certain way on a proxy, the SEC comes and knocks on your door and says, you didn't file your ownership forms correctly. You were effectively operating as a group in a coordinated fashion. You need to disclose that. And if you were over 20% of the company, you need to issue a takeover bid. So I think there's a big issue with non-enforcement from the SEC in terms of group formation. And then there's another issue, which I think Vivek outlined very clearly, which was this issue of, if producers of a particular product coordinate together to suppress the supply of that product, in this case, they say to save the world, to save the planet from climate change, but the reality is they're also getting a higher price for the product that they're selling in this coordinated fashion, that would be a classic antitrust violation. And I think we're going to need the AGs. I think we're going to need the red state pension funds. I think we're going to need politicians, in addition to shareholders, all working in the same direction to try to disrupt the ESG movement.
Vivek, there's one issue that's top of mind for a lot of Americans, and that's oil and gas prices, right? They're seeing this at the pump. What role has ESG played in setting America up to fail in that space, such that gas prices are what they are, and what should we be doing about it?
So this is a subject of debate. I have a firm view on it. I think the ESG movement has resulted in a systematic underinvestment in oil and gas over the last 5 to 7 years that set us up, predictably, for a massive supply-demand imbalance for global energy, which is where we are. And yes, Vladimir Putin did invade the Ukraine, but that was just the trigger for exposing backdrop conditions that were set up for somebody else can light the match, but the powder keg was set to explode either way. And I think that in some ways, I hope we actually learn the lesson starting that Western Europe actually learned, right? Western Europe shot its own ability to produce its own energy supplies, its own oil and gas, that created the very reliance for having to actually rely on Russia for natural gas. So I sometimes joke around that ESG now in this year stands for export Soviet gas, because that's actually the effect that it's had on global markets. But in all seriousness, if you think about putting yourself even in Putin's shoes, there's a cost and benefit to taking a course of action. He knows the West is going to be constrained by the sanctions that they're going to apply to Russia based on the fact that they're reliant on Russia for providing their energy. I'm not saying that was the one decisive factor, but it is a factor in the cost-benefit analysis. Now, on the flip side, there's an optimistic lesson here for the United States as well, which is that Europe would be living according to a second or third world standard today if it were not for liquefied natural gas, LNG exports from the United States. And were it not for that, Europe would actually be toast. And so for the United States, this could be a wake-up call both on the positive side and the negative side to say that we don't actually go to war with our own ability or our own company's ability to produce fossil fuels, but rather our ability to rely more effectively on domestic production of fossil fuels is actually both geopolitically important and economically important. And yet the ESG movement has actually accomplished much more through the private sector, has dampened, so by ESG, what do we mean? The mandates that large asset managers have imposed on the industry through the private sector, I think have had an even more disastrous impact on oil and gas production in the United States than even government regulation, which is actually what gets more of the airtime in public debate.
Yeah.
And this is to the point that Sean was making earlier. What's the essence of what's going on here? Why does the SEC turn a blind eye to certain forms of behavior while taking aggressive enforcement in others? I think part of what's happening is that you have a party in power in the United States that is conveniently using the private sector as a vehicle to get done through the back door what it actually could not get done through the front door. Right? There was no Green New Deal passed through Congress because there wasn't the political will or support to get it through the front door. But what you do have is John Kerry, who's the self-appointed climate czar, who actually has gotten every major financial institution in the United States to sign what is called the Climate Pledge. That includes companies pledging not to drill to Arctic drilling or drilling in Alaska. That would have been one of the policy agendas that they wanted to pass through the front door. There wasn't enough political support for it. And so that's part of why people miss the show in pointing to all of the destructive policies passed by the Biden administration. I think that's actually that's had a smaller impact relative to the ESG trend in the private sector to actually undermining our ability to produce oil and gas effectively in the United States.
I'd love to hear from each of you, because I think you may have a slightly different take on this. What are the implications for philanthropy and the way philanthropic dollars are invested when it comes to ESG? Why does everybody in this room, why should they care about it? Sean?
Well, I think certainly as philanthropists, but I think just generally as participants in our society, this matters. I think as owners of common equities, this matters. And so we're going to have to get off the sideline if we're going to win this fight. If you go back to the constraints on energy investing here in the United States, and you make it specific, I think that helps clarify what actually needs to be done. So in the case of Exxon, we lost 3 board seats to engine number 1. This was in 2021 in the proxy season. As a result of that loss, Exxon committed to constrain their capital reinvestment back into hydrocarbons to it's a nominal dollar constraint, but it's a little less than a quarter of their cash flow. So you're talking about a company that could be investing pretty close to $100 billion back into developing oil and gas assets that's investing currently a little less than $20 billion. And so the reason they're doing that is because they won the fight. And if you look at, I don't know how many of you own S&P or own Exxon or voted your proxies this last year. If you look at the re-election of these directors this year, and I brought up the sheet on this, the 3 engine number 1 directors were re-elected this past summer with 98.1, 98.3, and 97.0% of the vote. And so if you're looking at that, you're saying, well, gosh, the people that want Exxon to behave differently, not only, they don't even care enough to vote their proxies, right? They don't even care enough to move their money away from passive managers that are going to vote their proxies in favor of these 3 directors that have a mandate to suppress oil and gas production at Exxon. And so until we start to get those numbers down, until we actually start to vote what we believe on these proxies, the other side, we can say whatever we want. I just think they see there's no fear. There's no real concern that we're actually going to do anything that's going to threaten their ability to remain on these boards, their livelihood, to do whatever they want.
So I think there's 2 reasons why philanthropy should care. One of the reasons relates to your balance sheets, and the other of it relates to your mission as a company. And I think the latter is even more important than the first. But the first is the easiest. It's actually what Sean basically laid out pretty well there, which is that, ironically, you may work hard in your day jobs, making grants, making donations to causes that you think advance a better world, valuing every individual, something that we talk about the Roundtable as part of the True Diversity Initiative. We may think that we're advancing that. Yet our own dollars, through the investment accounts, through the balance sheet where your dollars are invested, are actively undermining the very agendas where you may spend your day job. So I'll give you a very specific example. I mean, I wrote another shareholder letter to the board of directors of Apple recently on behalf of Strive, questioning their decision to adopt a racial equity audit. Now, why did they adopt this racial equity audit? Because BlackRock and State Street voted in favor of it. That was this year. Now, the party that put up the proposal, and BlackRock and State Street say this is all about long-run value creation. This isn't about politicization of the boardroom. This is how you create value in the long run. One of the things I like to do is let's take a look at the motives of the people who actually put up the shareholder proposal and those who supported it. One of them was an organization called Color of Change that's stated purpose in putting up this proposal was to hold Apple accountable for its role in perpetuating white supremacy. Their words, not mine. A noble goal, perhaps, but not one that seems to have to do much with value creation at Apple. And that's why Apple's board initially opposed it. But then after it got majority shareholder support, after BlackRock and State Street and others voted in favor of it, then Apple's forced to change course. Now, actively, as we speak, they're conducting their racial equity audit, which in turn creates effective quota systems in how Apple's able to hire its engineers. Now, that's not Apple doing it. That's not BlackRock's money being used to do it. It is your money. It is your foundation's money that is actively subsidizing and advancing that agenda. And I think that we have, for good reasons, I mean, this has been very opaque, but we have been asleep to that for the last 4 years. And so it would be a shame if you're spending your day job thinking that you're advancing, through the annual gifts or donations that you give. That's a small portion of the total balance sheet. The balance sheet is actually more than undoing that and then some with respect to the actual outcome that obtains in the world. And then there's the version of it that comes to the boardroom of the organization itself. And this is the part that relates to mission. And I think at the heart of this whole ESG debate is the question of institutional purpose. Okay? If you're a solar company, great, be a solar company. If you're a coal company, be a coal company. But don't force a coal company to be a solar company. And the same thing if you're a nonprofit. If your focus is on addressing, educational inequality, great, focus on addressing educational inequality. If your focus is on fighting animal rights for animal rights causes, that sounds great. But what the ESG agenda says is that all of those institutions have to adopt the same purpose, not your purpose, but the purpose dictated by the capital management class that effectively puts up the ESG agenda on offer. And I think in this question of diversity, since we brought up the Apple case, my own view is that sometimes we're even slippery in the way we talk about diversity, just elevating diversity of thought as an end in itself. I personally think that the kind of diversity we ought to pursue should fall out of institutional and organizational purpose. If you're a steakhouse, you don't want diversity of thought on whether or not there is it's morally reprehensible to kill animals for culinary pleasure. I would not make a good employee for a steakhouse for that reason. I'm actually a vegetarian for that reason. It's probably why I wouldn't make a good employee at a steakhouse. And that's diversity of thought, but not the kind of diversity of thought that you want to advance your mission or purpose. And so I think that's one of the things the Roundtable does a good job of, but I think it's one of the things that we all can remember in the face of this ESG debate is what's really at stake here is the question of institutional purpose, whether you're a company or a nonprofit, to put that purpose as your North Star and to have your social goals that you might pursue like diversity fall out of that institutional purpose rather than being a purpose that's superimposed as a common agenda that someone else tells you to adopt just because that is actually the fashionable conforming norm of the day. That's really what's at issue in this debate.
Mm-hmm. We talked a lot about the investment side of this. Thank you. Yeah.
Thank you.
Great point. We talked a lot about the investment side. It's incredibly important. Let's talk a little bit about what you got into there, and I'd like to hear from each of you. If there was someone in this room who hears this and they've been thinking a little bit about this and they want to do something about it philanthropically, they want to challenge ESG philanthropically through dollars to an organization, to a cause, what are some of the ways they could do that, and how are each of you pursuing that? With anything you're comfortable talking about in an off-the-record setting, I should add.
Okay, well, as an energy investor, I would say this, as horrible as ESG is, it's actually a great opportunity in terms of the capital markets, right? Because you have a lot of investors that want to invest in the space. You have a number of companies that are impaired because of their, they've been co-opted by the ESG movement. So I think there's a real opportunity in terms of, as investors, as capitalists, investing in companies that haven't gone down this path. If you do the company-specific analysis, I think that's a real opportunity. I think the second thing we should all be doing, philanthropically, if we have endowments or personal assets, is we shouldn't be partnering with our adversaries. And so as you're seeing red state pension funds pull assets from BlackRock or Vanguard or State Street, if they're not aligned with your values, if you can see how they're voting in the 2022 proxy season, let alone the 2021 proxy season, why are you going to let somebody you disagree with engage with management, show up in that room as your representative, as the owner of that company, and advocate for things that you really oppose? When you look at red state pension funds, if red state pension funds behave the same way blue state pension funds have over the last 2 decades, we wouldn't be where we are today. The reality is red state pension funds they've devolved a lot of the responsibility for the management of their assets to money managers who are not aligned with their state's values. They're not voting their proxies the right way. They're not engaging. So to the extent that you have connections with the assets in red state pension funds, I think they really need to be the first actors that are going to pave the way for what can be done in the space. And if they behave like blue state pension funds have been behaving for more than a decade, we'd be in a lot better spot.
I mean, I think so much to be done. I'm going to focus on, one area that I spend my waking hours on now, which is actually market alternatives in asset management. Asset management is the one industry upstream of all the others. It directs the flow of capital into the economy to make sure that your own dollars are not actively subsidizing the agendas you think that you're fighting in your day job, right? So, I didn't think I was going to start another business in my life. I thought I was moving on to writing books and doing that kind of thing. But the reason I'm doing this is there was a vacuum in the market for people who actually were creating those vehicles. And so in the last few months, Strive has launched 3 index funds. One is an index fund for the U.S. energy sector, which that one has my favorite name. It's Drill. It's a very simple message for the U.S. energy industry. Drill, frack, do what you need to do to make most money in the long run without advancing a social agenda. We launched another one called the Strive 500, which is what it sounds like. It's the 500 largest U.S. companies. One of the themes when we launched that fund for Strive's message to corporate America was, for example, that hiring should be based on merit without regard to race, sex, or politics, period. Not an ask, not a suggestion, but a shareholder mandate to those companies to restore the idea of merit. And then the third was most recently the U.S. Semiconductor Fund that advised U.S. semiconductor companies via shareholder mandate to prepare for the China-Taiwan risk, an impending risk. Xi Jinping is now taking a third term, an unprecedented third term as the leader of China. I believe that starts the clock on when China invades Taiwan. That in turn disrupts our semiconductor supply chain, which could send big economic shockwaves throughout the United States and the world, yet which no other major asset manager talks about, because if they did, they might lose their license to do business in China. And so to provide a vehicle for people to speak with their capital, where some of these views may not be able to be shared in polite company, in a boardroom, or otherwise. But the beautiful thing about an index fund is that you're actually still speaking, but able to do it with the anonymity that an index fund traded on the New York Stock Exchange provides. And to do it not with the message to say that we're going to advance a particular set of values, but at least advanced value, which is what companies ought to be focused on. And so, I hope that and I expect that there will be more competitors on the back of, hopefully, if we're successful, others who step into that void and say, you know what, the idea is that companies should focus on their products to make money. It's a pretty basic idea. I'm going to actually bring some more index funds to market that also deliver that message. And I hope there's going to be a lot more choice in the marketplace than there is today, where nearly every major asset manager is tied to this ESG agenda. But my challenge to the group would be to make sure you're taking the same rigorous lens to the way your capital is invested, and understanding with whom it's invested and how they're voting your shares and how they're advocating on your behalf in boardrooms. Bring the same level of rigor to that activity as you do to the philanthropic side of how you're actually donating money or how you're actually running an organization. And I think if you're able to bring, I know people in this room do so well at the latter, that if you bring that same level of rigor to the way your capital is actually invested, I'm actually pretty optimistic we're going to make great strides in the next couple of years to addressing what right now is a pretty pressing problem.
We got a couple minutes left. I'd love for each of you to just leave the audience one kernel of wisdom, one final thought from each of you on this issue as we head into the next sessions.
You want to start?
Sure. I mean, I do think that, in some ways this is an unfair panel because we don't have the representatives of the other side.
Larry Fink's not here.
So I'd like to just get the two views that you would have heard from the other side on the table, just so people are aware of it. Because you'll hear this, when you go back and have debates or discussions in your respective corridors. The first is they'll say this is about long-run value creation. Actually, this is not about pushing a political agenda. It's just about advancing long-run financial value because this is the way the world is going. So you know what? That sounds great because this is the debate we ought to be having. Let's debate it on the merits as to whether a Scope 3 emissions cap at Chevron or a racial equity audit at Apple is indeed in the best long-run interest. Let's roll up our sleeves and have that debate. And if it really is, we should be open to the possibility that that's what these companies should be doing. I think what you'll discover in most cases is that that long-run veneer was just a farce. But I think that that's important to take the arguments of the other side seriously. But I think that then you're left with what's really going on, which is there's a social agenda that, to your question earlier, Wendell, there's still a generation of consumers that might be demanding it of those businesses. So that might be part of the long-run argument is that consumers who are my age and younger want companies to be engaging in these issues. And the closing thought I'll leave with is that one of the things we can do better, I could probably do better too, is to recognize that sometimes, at least in a younger generation, it comes from a good place, actually. It comes from a desire to, maybe a misguided desire, but a desire nonetheless to better the world, to actually make a contribution to bettering humanity, to fill this void of hunger for cause and purpose and meaning and identity that I think our generation, our moment in American history, we lack that sense of purpose and meaning and identity when the things that used to fill that void, like faith or patriotism or hard work or family or whatever, the things that used to fill that void for purpose, as they have receded in modern life, that's what creates the vacuum and the void that wokeism or ESGism or scientism, as distinct from science, actually fill. And I think one of the things that we all might want to think about, not just in the short term in combating ESG, but in the longer run, is what it is we can do as a movement to fill that void with something far more rich and far more meaningful than fast food. You don't satisfy a moral hunger with fast food. And I think that as much as we're focused here on just combating the poison, in this case we're talking about ESG, one at a time, that's just step one. But I think the lasting solution is going to have to be to fill that void for purpose and meaning and identity with something more rich and meaningful, that it dilutes these superficial agendas to irrelevance. And I think that's really the harder work ahead of us rather than just the short-term work of what Sean and I have talked about, which is necessary, but really just a first step towards that longer run goal.
Great points. Sean?
Yeah, I want to echo Vivek's last point there. So, which I think is a little in tension with kind of the Milton Friedman idea that he articulated so clearly in the early 70s, that the purpose of business is to make money, and if you're doing something else, then you're in some way violating your fiduciary duty. And when I think about businesses where the input's money, the output's money, and the purpose is to make money, I think about Wall Street. And if you think about companies where, certainly the big banks, where you don't really have attractive cultures in a lot of ways, that distillation down to just money as the purpose of a business doesn't really work as culturally. It doesn't really work to animate that enterprise, and it's not helpful. So you need something else. Part of the reason why we got ESG is, I think, in part because of the Friedman idea, which was we emptied these companies of values, and we said, look, it's all just really about making money. And that opened up the possibility for the left coming in and putting all their values into these companies and using corporate America as a vehicle to accomplish what they want to accomplish politically, culturally, socially. So we really do need something that is a higher purpose. I think Howard Schultz, who's on the wrong side of a lot of issues, did a great job in terms of talking about the higher purpose of Starbucks in terms of coffee and community and what they're trying to do. When he makes it political and gets into race relations and does a bunch of other things, he goes too far. But I think that's a good model for how the product and what you're doing for the community can really be elevated to something that can motivate a company. Chick-fil-A is probably one of the best examples, where you have a deeply religious family running a company that has a higher purpose. It's clear to everybody in the United States, the restaurant's closed on Sunday, that business has a higher purpose, and yet it's the best restaurant in America. And you got to ask yourself, would that survive as a public company? And the answer is, I don't know, probably not, right? So you need to have a set of values, and you need to create a culture, starting with the C-suite and the boardroom, that's going to embrace that larger vision of what business needs to do. And it's not just a very green-eyed shade, make a dollar. It has to have a bigger vision, and we have to be part of that solution. The left's advanced their vision, and I think we're still in the starting blocks when it comes to that.
Those are great closing thoughts. Sean, Vivek, thanks for being here with us.
Thank you. Thank you. Appreciate it. That's good.